What's up? Welcome to More Than Mortgage. I'm Chad Anderson. That guy's Zach Jones, and we're talking about the CFPB today, Consumer Financial Protection Bureau. That's about the rocky of a start we've ever had on this show. Sorry about that. So let's get right into it. Donald Trump takes over the presidency, a month ago ish, and one of the things he wants to get rid of, CFPB, says it's a problem. It's a waste. Elon Musk claims that there's $711 million sitting in their account or budget or on paper somewhere. But let's really go all the way back. This was something created because of the financial crisis in the 2007 through 2010 window of our mortgage journey. And now we're looking at getting rid of this organization.
Mm-hmm.
And I think everybody can agree, Zach, like things got out of hand, like that was the problem.
Yeah.
But now we're doing a job and a service. And this is one thing that's always bothered me is that the mortgage industry, and it's because of what happened before, we almost get looked at as if we're crooks in a way, like we have this negative connotation.
Right.
Like, you're always trying to hide something from me. You're always trying to make an extra dime. You're not giving me the best deal. What is this fee for? What's that fee for? Why don't I get this rate? Why don't I get this? Why don't I get that? And everybody just kind of looks at our industry that way. And I understand why. But then the regulation has also put such a strain on it that it's made the job difficult. And we're talking about the largest sector of the U.S. economy. So anyway, tell us more of what you've read and know and your take on this CFPB thing with the current administration.
Well, I think it's important to understand a little bit of that history without going into a ton of detail about it. But, the things got pretty wild in the early 2000s. And then we had the kind of the perfect storm happened in 2008 with the multiple factors kind of coming together. We have this mortgage meltdown, all these predatory lending practices, and it was terrible. It was bad. And the recovery out of that entailed a lot of legislation, much of that promoted by Barney Frank, and that Dodd-Fellow. I don't know what his first name was.
I just know Dodd-Frank. That's all
the Dodd-Frank Act really promoted a lot of this. And the CFPB, the Consumer Finance Protection Bureau, was a giant government entity that was spawned out of that. So, it was kind of one of those things. I remember I was in the banking side of mortgage at that point, and I can remember the buzz being, if it wasn't so bad, this new bureau wouldn't have had so much power. So this kind of came under the Obama administration. And what was unique about the CFPB is there was really no oversight from a governmental perspective. They were kind of one of these czar agencies that, well, who do they report to? Exactly what are they going to do?
Yeah.
But I can remember people talking about in the bank that I worked for, which will remain unnamed, being that they would be in a meeting, a conference of, the big muckety mucks. So this is the big, the top 12 in the company, and the CEO and the CFO and somebody would knock on the door, an undersecretary would knock on the door and say, excuse me, I don't mean to interrupt this most important meeting that never gets interrupted, but there's a gentleman from the CFPB downstairs and he's asking for a meeting. And everybody throws up their papers in the air and runs out of the room to go meet this guy from the CFPB because they had that much power. So that was, it's kind of a scary thing from the beginning. I think that one of the things that you got to understand about lending in particular, you talk about banking, CFPB does a lot of stuff, but they've had a pretty profound effect specifically on mortgage and then also on consumer banking. They do some good things. Yeah. There's some regulation in there that's good. But you got to think about if you create 100 pages of regulation to govern the practices of the way an industry does business, and those things do a good job, and they protect, and they put in fences, and they put in the guardrails, and make everything better and more efficient and have higher integrity, that's a great thing.
Yeah.
But the problem with legislation is that, or with regulation, is that it grows, because regulators, their job is to create and enforce regulation. And so if they have a budget for expansion, they've got to create more regulation in order to create rules for their regulators to enforce. And so a 1,000-page piece of regulation for a particular industry suddenly grows into 1,000, and then it's 5,000, and then it's 10,000 pages. And we've seen this in mortgage, where it gets more and more expensive for companies to do comply with all these guidelines and rules about things that seemingly, at least in my opinion, some of them have no purpose. And the greatest example of that is that we used to have a 1-page form called the good faith estimate. Maybe in some banks it was a 2-page form, and it had all of the fees with everything you can expect, the payment, the terms of the loan, everything was on a page or two, and it was simple and easy to read. It read like a spreadsheet. It's still a format that I use today when I'm explaining to a brand new newbie, first-time homebuyer greenhorn, this is what a mortgage looks like. This is the transaction. And they say, I spend 15 minutes going through it, and I say, golly, there's a lot going on there, but I understand everything. Thank you very much. And now you've got 7 or 8 or 9 pages in the closing disclosure and the loan estimate and all of this stuff that is convoluted and conflicting. And if somebody really paid attention to that form, it would be immensely confusing, and you really wouldn't know where you landed. And that's an evolution of where we're 15 years into this evolution of paperwork. So I think that's a great example. Used to be mortgage cost $1,000 or $2,000 in all of the support services that needed to be done in order to originate a loan, and that cost was borne by the consumer in closing costs. And now there's, I don't know, depending on the company that you work for, it can be $8,000 to $10,000 to maybe $12,000 per loan, and it's all integrated into closing costs and into the rate. So that's not good, because whether it's in closing costs or in the rate, the consumer's paying that. The consumer is paying now to abide by 12,000 pages of regulation as opposed to 100 where we started. And that's the bad side of both the good and bad side. We got to have guardrails on the industry, on all industries. We got to have guardrails, or people go crazy. The unscrupulous profiteers will do the wrong thing in the interest of grabbing more money. We know that. That's human nature. We've always done it. Cavemen did it. Let's go kill that guy because he's got a woolly mammoth. So we've got to guard against that piece of our human nature, but then to build these gigantic bureaucracies. And I think that's what this administration is going after and saying, hold on, let's just shut this whole thing down and let's see what's necessary. I'm kind of reacting to the Chicken Littles on social media saying, oh my gosh, we're going to go back to the cowboy days. Yeah. We still have to abide by the rules. It doesn't mean that if they put, some symbolic padlock on the door at the office of the CFPB in Washington, D.C., doesn't mean our rules go away. We're still working off the same system. So that's my take on it. That was a little bit long-winded, but that's my take.
I'm going to keep it pretty short here, unusual for me. But I would say, like, the biggest real life example that I can explain to everyone is that what Zach was saying earlier, it used to be 1, sometimes 2 pages of the good faith estimate. And it was just broken down nicely in a table format. It was like 10 to 12 lines or sections. It was just all easy to read, like very straightforward. Now we have this initial item called a loan estimate. That's 3 to 5 pages once you include all the names and contacts and license numbers and everything. Then at the end, you have the closing disclosure. And the closing disclosure is a similar form in the sense of what's on it, but it's set up differently. It looks different than the loan estimate does.
Confusing.
But it's the same content, but it's two different forms. And then this one has to be done 3 days before closing, which, okay, fine. But before, it's like, well, if it's 1 day before closing, I always tell people, if you don't like it, or if you think I'm lying to you, I'll send it to you. And if it's wrong, just don't close. Or we'll get it updated. And that's also another awkward thing with some of this bureaucracy and the dealing with the government forms, is that, how many times, and I don't say this to be misleading, but I have to tell people, like, look, if one item is wrong, that's extremely possible. It's not to bait and switch you. It's just that there's a lot going on, and a lot of this stuff are what the form says, estimates. So if it's slightly off, Mr. Borrower, I still need you to sign this initial one, and then we will send you updated ones as the loan progresses through the pipeline and the stages until we get to closing. And I have to say, the only one you should fear signing if it's incorrect is the last one. Don't
But
sign
it's confusing.
But it is. But that's what I mean. Like it is extremely confusing. You also have things on there such as, they're called aggregate adjustments. Nobody knows what that is. You have tax prorations that don't show up. You have like all these different things. You have FHA funding fee that's then partially refunded on the loan estimate, and it looks as if your down payment is less than what it really is. It's confusing to loan officers. Loan officers don't know how to explain it.
Right.
That's the point. And then the last piece is the disclosure packages, depending on your type of loan, they could be anywhere from 60 to 80, 90 pages of documents. My biggest beef with the disclosures is that it's so redundant, but just done on a different form in a different way with a different name, because one person thought that we needed to change this slightly or add it again. For example, you have the loan estimate, and then you have an itemization of fees. It's the same thing, but they're going, wait a minute, this here, it's here, but then it's here again. And I'm trying to follow.
Right.
The government just has so many forms that we kind of lose sight of common sense and getting just very easy, simple. And instead we've now confused people and made it. And I'm not saying that others in the industry in the past haven't taken advantage. That's probably why we have all these forms. But at the same time, it's never going to be perfect. And that's why who you work with matters. And you need to figure out how to simplify it, because that's the hardest part, really, is that all the forms are so redundant and so confusing that people just lose sight of it amongst all the paperwork. Also, let's be honest. Who's reading all 60 pages, right? Like, Zach, you sign up for something on the internet. When you scroll through and you do your accept the terms and agreement, you ever read that whole thing?
No.
You're just scrolling to the bottom until you can hit the box, right? Nobody does. But then that form is there to protect someone or to do this but then you agreed to it. So that's why it's allowed. It's such BS, and it drives me nuts. Politicians also drive me nuts with it on both sides. The people who don't even understand what we do day to day. And it's just really frustrating. So we'll see. This administration's only a month old. So what happens going forward, it should be fun, is all I know to say on some of this.
Yeah, I don't see a lot of the rules going away and a lot of that stuff, but I do see that the enforcement will probably it won't be as targeted. I don't know. I hate when I see Wells Fargo getting fined for another $70 million for, they were probably guilty of whatever they did, but that $70 million comes back to the consumer in fees. Yep. Ain't nobody hurting Wells Fargo. They did, this is that's that kind of Washington posturing that I see. I'm going to stop before I start saying other words, but we need to trim this down. So we'll see how it goes. I don't think that the sky's falling one way or another.
All right. Check us out on the socials up here: YouTube, Instagram, Facebook at Zach Jones Loans, at Mortgage Dad Chad. Like, subscribe, comment, download, DM, hit the bell, share, whatever you got. Do all the things. Our views have actually ratcheted up quite a bit lately.
Good for us.
We appreciate that because this has been over a year and we've stayed consistent, and we've really been trying to deliver quality content that's interesting and maybe keeps you in the know with all the real estate industry and the mortgage side. So thanks for being a part of it. We appreciate you, and we'll catch you next week. Take care.
See ya.